Thank you everyone for joining us on this evening's earnings call. I have a few updates to make on our capital markets, on our equity, on our digital credit, and then I'll conclude with updates on our capital market strategy overall. If you had asked us at the beginning of the year, what was our target for the year in terms of capital markets raises, we would have said it was uncertain, and it really depended on the success of the Stretch product. And I think 4 months in, we can say that Stretch has been more successful than we had expected at the beginning of the year. And one representation of that is the amount of capital that we've been able to raise for the company and ultimately for Bitcoin. And you'll see here, year-to-date 2026, we've raised $11.7 billion, as Andrew had mentioned, notably about half from issuances of our common equity, half from issuances of our preferred, primarily Stretch, and no longer are we issuing convertible debt to raise capital. How does that compare to the rest of the U.S. capital markets, equity capital markets? You'll see last year we represented about 8% of the equity capital markets in the full year 2025. We were the largest issuer, and we are again this year the largest issuer in the equity capital markets, about 10% total, 6% of common equity, and 60% notably of preferred equity. And we're doing what we said we would do and what we were trying to do, which was to shift our ATM more towards credit. And you see this even pronounced as we look at each month of the year 2026. We started in January with 20% of our equity issuances using digital credit, 88% using MSTR, and we've largely flipped that number in April, with 17 using MSTR and 83% using digital credit, which of course is also less dilutive to our overall shareholders. Research analysts have been consistently supportive as we look to exit the Bitcoin bear cycle that we're in. The average price target of all of the equity analysts covering strategy for Bitcoin is $138,000, which is about a 70% increase. The average MSTR price target is about $323, which is an 80% increase from current levels. So let's talk about digital equity and MSTR overall. We show this chart every quarter. You can find it on our website, strategy.com. But this is our annualized asset performance since we adopted the Bitcoin standard. August 10th of 2020 is when we look back to. We've outperformed Bitcoin by about 50%. Bitcoin has outperformed the Mag 7 by about 50%. And the Mag 7 has outperformed the S&P 500. So our ultimate objective is for our common to outperform Bitcoin by accreting Bitcoin per share. And based on this chart, we've continued to deliver on that performance. As Andrew mentioned, our Bitcoin per share is also accreting. That's our business objective ultimately. And we're at 9.4% Bitcoin per share increase so far this year. And you'll see that's also accelerated in the last month, right? We started off a little bit slow in January and February, 0.4 and 0.1% increase in the month of March with 3%, and really increased, doubled in the month of April with 6%. Last quarter on this call, we said our objective is to double Bitcoin per share in 7 years. Doubling Bitcoin per share in 7 years implies about a 10% annualized BTC yield. And as I mentioned, so far this year, we've increased 9.4% our BTC yield. So we're well onto our annual target, and we've been happy with the success of Stretch so far this year. And ultimately, MSTR continues to be one of the most widely held equities around the world and the most widely held Bitcoin proxy in the world. And we're able to reach 1,400 institutions, 927,000 retail accounts, 1,300 ETFs and funds, over 100 million beneficiaries that share nearly 4% of the Bitcoin in the world. So I don't think about this as concentrated amongst one company, a set of leaders, but really amongst 100 million people that we're sharing Bitcoin with per share around the world. So let's talk about digital credit, our favorite topic so far this year. Look, the idea of preferred capital and preferred credit is not a new idea. In fact, the Industrial Revolution was built on the railroads, which was built on digital credit, built on analog credit through preferred capital. At that point in time, during the late 1800s and early 1900s, 20 to 40% of the capital structure around the world was preferred capital. What happened in the mid-1900s and the early 2000s is the rise of liquid debt markets, increased regulation, pushing preferred capital into what I would call niche use. Now, as people are waking up to preferred capital and digital credit especially, we're seeing a reemergence. And my analogy here is where preferred capital helped build the railroads, which helped drive the industrial revolution. Now, digital credit will help drive the digital railroads or the digital rails. It will drive the digital revolution, including the AI revolution. So we're excited about bringing this back to the forefront of the world. If you look at an overview here, we have 5 preferreds. We've mostly been focused on Stretch so far this year. I think there's an opportunity for the remaining preferreds to start to perform as Bitcoin starts to perform. But Stretch is clearly the tip of the arrow as far as digital credit. And so that's what I'll talk about primarily. We're up to 11.5% dividend yield. Notably, we've kept this flat for the last 2 months, right? So we've increased the dividend yield from 9% to 11.5%, and now we're flat for the last 2 months because what we've seen is the volatility has started to decrease. The price has started to remain stable, and we've seen an increase in Sharpe ratio, 2.53. So the notional value is up to $8.5 billion, and we're trading $375 million a day. And I'll share how that compares to other preferred equities and also common equities in general. The first thing I'll note is the rapid growth of Stretch. Right? In just 9 months, we've raised $8.5 billion of capital. We had a running start with $2.8 billion. It slowed down and it's really accelerated over the course of the last couple of months. Comparatively, this is one of the most successful financial instruments ever created in terms of capital inflows. It's second only to IBIT. Compared to other products, it has seen faster growth in terms of capital inflows than famous products like the iPhone or Google AdWords. So we're very proud of the acceleration of the product, and it means that we built something that is resonating with people in the US and people around the world. Stretch is by far the largest tradable preferred in the world. Right? We're nearly 2 times the size of Wells Fargo's preferred. And you'll see here what's interesting is almost all of these other preferreds, save us and another one, are bank preferreds. So this has gone from being an industrialized product that's building the industrial revolution to a niche financial product. And we're excited to bring it back to being a major product in the world. The liquidity of Stretch, so this is the average 30-day average trading volume, is 25x the second largest preferred. So where Wells Fargo is about half our size, is trading 1/25th of what we're trading at $15 million versus $375 million. And what that means is with that liquidity, the turnover of the next best preferred, we're at 4.4%. 10x of what Wells Fargo is and some of these other products like Bank of America products. So we think we really found a new product category, digital credit, based on an old product category, preferred capital, and we're excited about where this is going. Interestingly, and as we pointed out before, Stretch is performing not just as one would expect in a bull market, but performing in a Bitcoin bear market. So while Bitcoin has gone down 37% since the beginning of October, now it's starting to rise again. We're seeing Stretch trade essentially near par and paying dividends that are increasing in a monthly. So we've increased the dividend, as I mentioned, from 9% to 11.5% and kept it steady at 11.5% for 2 months, now going on 3 months, while Bitcoin has been decreasing. And so with that, we've also seen the ATM velocity of Stretch has accelerated. And the ATM velocity is really the net inflows into the product. Right? This is the demand of the product overall. And you'll see notably in April, we had a week where we raised $1 billion. And then the subsequent week, we raised $2.2 billion. And so we've seen tremendous demand coming into Stretch. And at the same time, we're seeing the volatility decrease. And so our target price range for Stretch is $99 to $101. We've actually seen it trading in a much tighter range. And for the last 3 months, March, April, May, it sat in that price range for 100% of the time. I mentioned here the daily liquidity is pretty significant, but it's also growing, right? So from $54 million to 120 in January to 250 in March to 360 in April. So for those who are interested in getting into the product in size, if you're a corporate or if you're a large institution and you need to have confidence that when you need to trade in and out, you need liquidity, our product is showing that level of liquidity. I'll go through a series of analyses of Sharpe ratio, because Sharpe ratio ultimately is a measure of the returns above the risk-free rate given the volatility of the instrument. And ultimately, if you're an investor, people are looking for high Sharpe ratios, right? So compared to traditional credit, junk bonds, investment grade bonds, bank preferreds, we outperform pretty notably. Compared to traditional asset classes, the S&P 500, even Bitcoin, NASDAQ, etc., we also outperform very notably. And then obviously, if you're looking for Sharpe ratio, a lot of folks go to the Mag 7 equities, right? And NVIDIA is obviously on a hot tear because of the AI trade. Google runs essentially a digital monopoly and has been a very solid equity over the course of the last 20 years. STRC has outperformed all of those and all of the Mag 7. You know, another place people typically go to find a high Sharpe ratio are hedge funds, right? Hedge funds are built with different strategies, different analyses, different quant strategies, and typically they're built to outperform the S&P 500 and with lower volatility. And here what you'll see is looking at different hedge fund strategies, STRC to date, you know, notably, you know, and understandably early in its maturity, is already outperforming these different hedge fund strategies, whether you're a multi-strat, whether you're a macro, equity, arbitrage, etc. So we see a lot of benefits to this emerging category of digital credit, right, when compared to hedge funds, private credit, private equity. One is extremely liquid, right? To get these levels of returns and these levels of Sharpe ratios, sometimes people subject themselves to 90-day lockups for hedge funds, 3 to 7 years for private credit, 7 to 10 years for private equity. We charge no fee, right? These other strategies often charge a management fee of 1 to 2% and a 10 to 20% carry, right? A 2 and 20, if you will, right? Digital credit is homogeneous. You know exactly what's behind it. It's Bitcoin. These other strategies are sometimes heterogeneous with many different assets grouped together, making it very hard to ultimately assess the risk. Ours is scalable through an ATM mechanism that allows people to buy the product, and hedge funds and other strategies are discrete. We're accessible, traded via 4-letter ticker on the NASDAQ, and now, interestingly, trading on many tokenized exchanges and tokenized products. The other ones are typically restricted to those who are accredited institutional investors or high net worth individuals. And we're transparent, right? We disclose our performance, our holdings through weekly 8Ks and websites that update every 15 seconds. So one of the big questions as we have seen STRC perform over the last 4 months, essentially the year 2026, is what does this mean for our capital market strategy, right? And I'll introduce this topic and Mike will talk about it a lot more, right? And so we said our objective is to double Bitcoin per share in 7 years through the success of digital credit. And so what does that mean? We sell digital credit, right? And we've said that we target about 10 to 20% of Bitcoin reserves annually in digital credit volume. And of course, we'll analyze that and assess that to see if that target makes sense. But that will generate amplification to our common stock, right? Which should increase the Bitcoin per share in our common stock, which is ultimately our goal. And as we increase Bitcoin per share, that allows MSTR to outperform Bitcoin, which is what we've seen happen over the last 6 years, right? What allows us to flex these levers even better if our cost of credit goes down, right? If we're able to decrease the yield from 11.5% to lower for a variety of factors, if we're able to sell more STRC, that increases amplification. And if our MNAV goes higher, and I'll talk a little bit about our MNAV, but that also creates benefits, for example, our cost of paying our dividend. What has happened in the last 4 months is we have increased optionality for strategy of the company, right? We have more sources of capital and we have more uses of capital than we ever had before. And the successive stretch gives us options to do different things from a capital markets and a treasury operations perspective to benefit our common shareholders. Right? Our traditional sources of capital, sell MSTR, sell stretch, right? We could sell our US dollar reserve, right, to pay dividends, which we added in November. We also have Bitcoin that we have the opportunity and the option of selling. We can see our other prefs start to perform and sell those into the market. And we've talked in the past about also being able to potentially sell BTC or Bitcoin derivatives. What are our uses of capital, right? Primarily today, we bought Bitcoin. We use capital to pay our US dollar dividends. And we use capital to build up a US dollar reserve. We have used capital in the past to pay down our convertible debt, our secured loans, our Bitcoin-backed loans. We continue to do that in the future. And then we could also use capital if we want to in the right time to retire any of our other preferreds, right? So what does this really mean? This means we had 3 trades that we have executed. And really, before 2025, 2 trades. We sold MSTR, we bought Bitcoin. We sold MSTR, we bought US dollars. Last year, we added stretch and prefers, and we sold stretch and we bought Bitcoin. Now, we're really seriously thinking about and contemplating and want to introduce the concept of a few more trades, right? Selling MSTR at the right MNAV, whereas Bitcoin per share created to buy back debt. What does that mean? Considering retiring potentially early some of our convertible notes using our common stock. Selling stretch to buy US dollars, right? We haven't done that much to date, but perhaps reserving part of our stretch proceeds to build up our US dollar reserve. And then selling stretch to buy back debt, right? You can see how that would be an accretive trade to Bitcoin per share because stretch inherently on sale is not dilutive and buying back future dilutive convertible shares, right? And then the third sort of set of interesting trades that I sort of previewed on the last slide is selling Bitcoin, right? And this is a big sort of statement, but our ability to sell Bitcoin either to buy US dollars or sell Bitcoin to buy debt, if it's accretive to Bitcoin per share, right, is something that we would consider doing going forward. So how do we make these decisions? Ultimately, there are 2 sides of the same coin, if you will. One side is our equity performance, right? And to our common shareholders, the most important thing is to accrete Bitcoin per share, which results in higher BTC yield, which ultimately those together result in a higher BTC gain, right? Adding more Bitcoin and BTC gain on a dollar basis is the closest proxy to earnings per share. So those are the 3 KPIs we look to assess equity performance. On the risk side, right, the other side of the coin, right, we have a BTC rating, which is the amount that our debt and our leverage is over collateralized by Bitcoin. We have an MSTR duration, which is the average duration of all of our instruments, right? And so if you look at our perpetual preferreds, they have the longest duration based on a Macaulay duration basis, 10, 15 years out. And then we have our convertible debt, which has a shorter duration. So swapping longer duration for shorter duration is a good trade for us, right? And then we have MSTR risk, right? And so the BTC rating and the MSTR rating together influence the total risk profile to the company. And so we'll talk through a little bit more about this framework later. A couple things I want to note before I hand it off to Mike. One is Bitcoin per share accretion is our primary goal. MNAV is an input, right? The threshold for Bitcoin per share accretion when selling our equity and buying Bitcoin is increasing over time, right? So where it used to be a 1x MNAV, as we add debt and as we add preferred primarily to our structure, the break-even increases. Right now it's about 1.22x. That means at 1.22x, or higher MNAV, it's accretive for us to sell MSTR and buy Bitcoin. Below 122x MNAV, it's actually more accretive for us to sell Bitcoin, right, and pay off our dividends than it is above 122x MNAV. And so that's a note, and we'll talk more about this and we'll explain it further. But it's an important point because I think there is a misconception that the break-even point is 1.0x. Next thing I'll note, there are benefits to the way we bought Bitcoin and the holdings of Bitcoin that we have by cost basis tier. And you'll have this here, taking $20,000 tranches, 0 to 20K, 20 to 40, 40 to 60, 68 and beyond. We bought Bitcoin at every price level. Below current price is about 80K. We have an unrealized gain from a tax basis on that Bitcoin. Above 80K, we have unrealized losses. If we were to sell Bitcoin, our objective would be to sell high cost basis Bitcoin to capture some of those unrealized losses and to take some of those unrealized tax benefits, of which on our balance sheet, there's about $2.2 billion, right, estimated of tax benefits. So there is a tax benefit if we were to sell high cost basis Bitcoin as an example, right, to pay down some of our dividends over time. Amplification. We're currently at about 34% amplification. A portion of that, about 10% of that, is driven by our convertible debt. The ability for us to increase amplification to the company is higher when we have long duration digital credit than it is when we have short duration convertible debt. So as the company starts to cycle over time from convertible debt to digital credit, we can take on more amplification with lower risk levels. And so we could see ourselves getting 50, 60% amplification levels over time and still feel like we have a high credit quality and a high risk quality to the company. And the last thing I'll share here before I get to some of our principles is the US dollar reserve, right? We have built up a $2.25 billion US dollar reserve, which at that point represented over 2 years of dividends and interest payments. And now we're with the same exact US dollar reserve at about 1.5 years. Adding to the US dollar reserve reduces Bitcoin per share, but improves the credit quality of the company. And so it's something that we'll continue to evaluate over time, what the right level of US dollar reserve is. We feel like at a minimum, it should be $2.25 billion, but likely as we grow our digital credit and stretch, we will want to add to this at a certain level. So I'll summarize what I shared here because hopefully it addresses a lot of questions from our shareholders. How do we think about managing capital markets and our balance sheet? One, our objective is to create long-term value for MSTR, right? We want to increase Bitcoin per share, which will increase the price of the common equity and ultimately be better for our common shareholders. Two, we're going to continue to grow demand for Stretch. We've seen it to be a very popular product in the market and very beneficial to our balance sheet. And we'll continue to improve the features as we can. For example, moving to semi-monthly dividends. Three, we are going to proactively reduce convertible debt based on market conditions. And that could mean actively purchasing back through whatever means we think appropriate some of the convertible debt before it comes due. Right. Fourth, we're going to look at the stretch demand and credit risk to determine the size of the US dollar reserve. There's a natural market mechanism that as the US dollar reserve in months to cover or years to cover decreases, the credit risk of stretch goes up nominally and could decrease the demand. And so we will monitor that to decide what is the right US dollar reserve size. Fifth, similarly, the amplification, the appropriate amplification for the company will also base on market conditions. Right? Mike and I and Andrew and the entire team are looking literally every day at what are the trades that are accretive to Bitcoin per share, what are the trades that create the right equity accretion, and what are the right trades that manage the credit risk at the right levels. And six, not necessarily most importantly, but maybe most notable, we will sell Bitcoin when it's advantageous to the company. right? We're not going to sit back and just say, we'll never sell the Bitcoin. We want to be net aggregators of Bitcoin, increasing our total Bitcoin, but more importantly, increasing our Bitcoin per share, because we think that is what is going to be most accretive long-term for MSTR and for the common. And with that, I will hand it over to Michael Saylor to complete the presentation.
Thank you, Fong. I thought I'd elaborate on some of the things said up till now and just give you an overview of the BTC market and then our capital market strategy. Everything is based on digital capital, and Bitcoin is digital capital, and that means global, legitimate collateral, global property. So we keep track of Bitcoin as digital capital and the consensus in the market. And what you can see here is the US government has embraced it. All of our key financial regulators, the head of Treasury, the head of the SEC, the head of the CFTC, and now the incoming head of the Fed are all digital assets enthusiasts, innovators, and Bitcoin believers, as is the President of the United States, Donald Trump, and the Vice President, J.D. Vance, along with many, many other cabinet members. And I think that's a very important fact. There are a lot of bills still working their way through Congress. The most notable one right now is Clarity. The real key here is that Bitcoin is a priority in the House, in the Senate, on the Hill, at the White House, and there's bipartisan support and bipartisan agreement for Bitcoin as digital capital and for legislation that supports the adoption of Bitcoin as digital capital in the world. Really exciting. A few months ago at our Bitcoin for Corporations conference, we saw major announcements by systemically important banks, Morgan Stanley, Citi, TD, all with intent to integrate Bitcoin into their operations. This is something we only hoped for 3 or 4 years ago, and now it's reality. And at the point that Bitcoin's integrated into the banking system, then it's digital capital here to stay. You can just see the announcements across your ticker, right? Everywhere in the world. This is a global phenomena. It turns out whatever happens in the US and with the US banks is spreading to Europe, to the UAE, to Hong Kong, to South America, etc. I think you're going to see these announcements accelerate, but we've crossed the event horizon, and it's pretty clear that you can't put the genie back in the bottle. Bitcoin has arrived. We try to be systemic, so we track it, and we track the 15 largest or most systemically visible banks in the world, and we look at their embrace of Bitcoin as a creditworthy instrument. Will they trade it? Will they offer credit against it? Will they custody it? Will they handle the derivatives, etc.? And what you can see here is that adoption has actually advanced since even last quarter, and everywhere in the world, across all of these banks, there are active efforts to improve Bitcoin support. If you track the number of accounts that support Bitcoin access, you can see we're marching up into the high hundreds of millions, 840 million crypto exchange accounts, nearly 1 billion neobank accounts, nearly 1 billion brokerage accounts that all have access to some sort of Bitcoin derivative. ETFs, of course, continue to embrace Bitcoin. There's now been 125 ETFs with about $126 billion of capital. The capital flowing into these ETFs continues to accelerate. And as you can see, we were the first company to embrace Bitcoin, and now we're up to 194 public companies. We anticipate this will continue to grow. Lots and lots of IPOs. The public markets have embraced Bitcoin, and this is just an example of some of the notable companies that have come public just recently that have substantial Bitcoin exposure. The digital credit ecosystem has been a very pleasant surprise. It has grown very rapidly and has become very diverse. And the way that we know that digital credit is working is that companies and economic actors everywhere in the world that we've never met face to face are discovering this, and they're building products and businesses around it. So right now, what we see is very enthusiastic support with retail investors, with corporate treasurers, with institutional investors, with crypto native innovators, and with TradFi innovators. So 5 different groups of capitalists, but they're all getting very heavily involved enthusiastically and rapidly. If we drill into retail, 80% of all STRC shares is held by retail as of our last check. This is an extraordinary fact. Normally, it's very difficult to get broad, deep retail support for a common stock or a public stock, and yet we've been very pleasantly surprised. We're able to trace about 120,000 individual retail accounts. Word of mouth is spreading this. It's spreading virally. Based upon our studies, we see that anybody that buys STRC is generally telling their friends, their family, their parents, their working associates about it, and it continues to spread word of mouth. You can also see Schwab is a big distribution channel. 23% of Stretch is held in Schwab accounts. Fidelity is a channel. Robinhood is a channel. Morgan Stanley and E-Trade are channels. BlackRock is a channel. Interestingly enough, Vanguard, that won't let their investors buy Bitcoin natively, they actually are a channel for Stretch. And so it's pretty exciting that we have wrapped Bitcoin into a credit instrument that is being distributed through all sorts of traditional finance channels to types of investors that otherwise would never be able to buy Bitcoin itself or would never want to. We actually have traced Stretch exposure, and we estimate that there are about 3 million households that are benefiting from Stretch right now. So think of it as powering a savings account for 3 million households. Fong mentioned about 100 million beneficiaries of MSTR. Well, 3 million beneficiaries of STRC in 8 months is a pretty good start to the race. Our ambition is to spread this to tens of millions and then hundreds of millions of people. So we're off to a good start, but we're just very enthusiastic about the retail support. We're also very enthusiastic about corporate support. Corporations, unprompted by us, we didn't go and sell this to them. They just figured out that it was a good idea for them. But corporate treasurers and corporate CFOs with working capital have been allocating some of their treasury capital to Stretch. And this is a really pleasant development. And, we're starting to think that there might be thousands of companies that might allocate some amount of their treasury capital to Stretch. And, I've had a lot of experience selling BTC to corporations. What I found is that tends to be a board level decision. It goes all the way to the board of directors. The CEO has to be way behind it. And if one director on the board has concerns, the cycle slows down. But with STRC, it's not a board level decision. It's more like a CFO level decision. If the treasurer is enthusiastic, the CFO can green light it. They might or might not give the CEO a heads up. But this is a very different value proposition. It's maybe a 5-minute conversation with the CEO instead of a 2-hour conversation with the entire board. For that reason, we think that STRC really is Bitcoin for corporations. It's going to spread very rapidly now. The other thing that's very exciting is that STRC has spread into credit indexes. BlackRock's PFF is a $14 billion credit ETF, and Stretch is the number 2 holding. VanEck's PFXF is another credit ETF, and Stretch is also the number 2 holding. And so imagine an instrument coming out of the blue, didn't exist 12 months ago, and in less than 12 months, we've gone from non-existent to number 2. Next stop, number 1. We're enthusiastic about seeing Stretch embedded in lots and lots of institutional credit indexes and lots of institutional credit funds. third-party ETFs have been finding stretch, and they're building innovative ETFs. Strive is building a digital credit ETF. 21 shares created an ETF with stretch and took it public in Europe. There's a number of ETF providers that are working with us that are in the pipeline right now. I think active discussions with 4 right now. And so we would think that over time there'll be more ETFs that build STRC into their fund offering. So here I'd like to talk about digital money and digital yield. We start with digital capital. Bitcoin is 34 vol on a rolling 30-day average. It's 39 ARR. The 1-year trailing vol of Bitcoin is almost 40. So think of it as a 40 vol, 40 ARR asset, raw economic energy. We split that asset into STRC, which is 3 vol, 11.5% yield, and then MSTR, which is 71 vol, 59% ARR. So one's an amplified Bitcoin we call digital equity, and the other one is damped, digital credit. Now, digital credit, we believe, is like the kerosene of finance, right? It is the monetary fuel, and is a universal monetary fuel. It's high grade, highly distilled, but from here you can build all manner of products. And we see the layer 3 as digital money and digital yield. Neither of them would really be possible without digital credit. It's just too difficult to distill pure 0 vol 8% money from a 40 vol 40 AR asset. You have to crack it. You have to have a crypto reactor, and you have to have 50 billions of dollars of equity capital to do it, and that's what we did to create Stretch. So simple definition, digital money in our lexicon is 0% volatility, daily liquid instruments built on digital credit, like 0 vol 8% yield coin. And then digital yield, that's non-zero volatility, or it might be illiquid. It might be a 3-month lockup, 5x levered, 35% yielding fund that loops digital money 4, 5, 6 times in order to get there. And so digital yield is a levered construct, and digital money is the stripped down construct. We think digital credit's programmable across lots of dimensions. There are a lot of ways to add value to it. You can tokenize it, put it in a private fund, put it in a public fund, put it in a bank account. You can deploy it on a crypto exchange, on a neo bank. You can deploy it on a real bank. You can deploy it on a crypto network. You can program it to have volatility of 0 or let it float up to a volatility of 10. You could program the liquidity to be continuous or daily or monthly, but you could also put in a quarterly lockup or an annual lockup in order to put more leverage on it or create a different characteristic. You can program the yield from 5% up to 25% reasonably. Some people might go beyond that, but we think 5 to 25 is reasonable. And then you can convert the currency. You can create Great British pounds or euros or yen or Swiss francs with digital credit starting from STRC. And so when you think about all these different forms, the question is, do you want to create a yield coin, like a digital money coin? Do you want to create a yield fund? Do you want to create an account, right? And depending upon what your assets are, if you're the biggest bank in Australia, or if you're Deutsche Bank, you probably would do it one way, but if you're a crypto exchange, you might do it a different way. The math is pretty straightforward. You start with 11.5% performance and like 3 vol right now. If we're lucky, maybe we'll be able to get our vol to 2 or to a 1 handle. I mean, that's the goal of our proposal to the shareholders. But I doubt seriously we get below a 1.5 or a 1 vol. 1 vol is sort of what publicly traded money market funds look like right now. But getting to 0 vol takes a bit of work. So So one approach to add value is to step it down, strip the vol to zero, and maybe instead of 3 vol 11%, you offer 0 vol 8%, and that's digital money. And the other approach is step it up, right? Lever it 3 to 1, pay 5% for the capital, and maybe you end up with something that's paying you like $35. You pay $10 on the capital, and you get a 25% yielding levered yield fund, and these are all opportunities. Where we are not going to do it ourselves. Our laser-like focus is make Stretch the deepest, most liquid, most stable, least volatile, highest Sharpe ratio credit instrument in the world. And that's a mission. But what we think is there are a lot of crypto innovators, and you see right here on this screen a lot of very impressive companies, that are moving fast right now. Apex has had enormous success early on. Saturn's doing the same thing. But Hermetica, Kraken, Roxum, Ondo, Pendle, Spread, Strata, they're all doing very interesting things right now, and they're very innovative, and they're moving about 10x faster than the TradFi complex normally moves on these sort of initiatives. But having said it, there's a lot of interesting TradFi initiatives, things you can do in a traditional finance environment, either with a private fund or a public fund, and we see those things happening as well. 8 weeks ago, there was no stretch in the DeFi industry. And in those 8 weeks, we have rapidly grown to something like $270 million of exposure. So this is just really extraordinary, the rate at which money is flowing. Sometimes money is flowing into this complex $1 million an hour, $2 million an hour. It's starting to feel to me like we may very well see more than $1 billion of stretch enter the DeFi industry in the near future. It's moving very fast and is very dynamic. So let's speak about outlook and our vision. We're a structured finance company, and you can see here we're taking raw capital, digital capital, 40 vol, 40 ARR, $1.6 trillion market cap of Bitcoin. We are stripping the currency risk. We are reducing the credit risk. We are compressing the duration risk. We are distilling a yield. We are damping a volatility in order to create various instruments. And our greatest product and biggest success right now is Stretch. As you can see, it's taking a 71 vol down to a 3 vol. We're targeting a 1 vol. Some important items to be aware. The Bitcoin break-even ARR, we calculate it all the time. It's very significant for this reason. If Bitcoin grows more than 2.3% a year, that break-even ARR, we can fund our dividends forever. We can fund our dividends forever without selling a single share of stock. It is a very critical point. If Bitcoin does not grow at all forever, we can fund the dividends for 43 years. We're very clear about this. You'll see we publish it on our website, and we update it every 15 seconds. So let's go to the next slide. Here you see, this is our website. If you go to the credit tab, you're going to see we show you the Bitcoin reserve. We show you the years of dividends. That's the years we have of coverage of Bitcoin appreciates 0% a year. And then we show you the Bitcoin break-even ARR, 2.27%. It's updated every 15 seconds. So for those people that are wondering, what is the credit risk in all of these instruments, I encourage you to go to the credit tab. You can go and you can type in, you can assume the Bitcoin price crashes to 30,000. You can change your vol outlook. You can change your AR outlook. The model will recalculate all of the risk and credit spreads for every credit instrument, and especially for STRC. And as I said, we're updating all of these things in real time every 15 seconds. There's a misnomer. Sometimes people think, well, Bitcoin has to appreciate 11% or 11.5% for us to be successful or cover the dividend. Not true, 2.3%. Or they think 30%. No, that's what we think it'll do. The number that really matters is 2.27%, the big BTC break-even ARR. Now, it's important for another reason. The BTC break-even ARR is also the inflection point where stretch issuance results in more Bitcoin being stacked by our company than the Bitcoin we use to pay dividends, if we choose to pay dividends with Bitcoin. So this chart here, what it illustrates is that we don't have to sell a single share of stock. We could stop selling MSTR common stock right now. We can fund the dividends with Bitcoin sales. And if stretch issuance is greater than that BTC break-even number, not only will we fund the dividends forever, we will increase the amount of Bitcoin that we hold forever at the same time. So you would say, well, how much is that? Well, you can see if we were to sell $1.5 billion of stretch per year, we can sell Bitcoin, pay the dividends, buy more Bitcoin than we sell, grow our Bitcoin stack, and generate Bitcoin yield. Now, of course, we sold $1.5 billion of Bitcoin in $1.5 billion in stretch in 2 days a few weeks ago. So yeah, I think we can definitely stay above that break-even point. What you see here on this slide is that if we actually have stretch issuance equal to 20%, that would equate to $12.8 billion of stretch sales this year. And we're kind of on the path to that if we look at the first 4 months of performance. We might exceed it, who knows? We might be less. But if we actually run at a 20% issuance rate, then the first order model shows or indicates that we generate a BTC yield of 17.7%. We accumulate an additional 144,000 Bitcoin, and that's after we pay all the dividends by selling Bitcoin. So again, the most important point here is there are occasionally some short narratives. People would say things like, well, if they sell the Bitcoin, that's bad for the business, or it proves the business doesn't work or something. But, we look at it as if you're a real estate development company and you bought land for $10,000 an acre and you sold it at $100,000 an acre, and then you bought more land with the profit. No, or if you sold it $100,000 an acre to pay some interest expense on debt that you used to buy more land, nobody would say that that's bad for the price of real estate, and no one would say that that proves the business doesn't work. Real estate development companies literally exist to buy land cheap and sell it expensively. We're like a Bitcoin development company. We buy it cheap, we sell it dear. Where do the dividends come from? Capital gains fund credit dividends, right? That is the essence of the business. We invest in digital capital, Bitcoin. The capital gains from the investment fund the credit dividends. They will do it in perpetuity if the capital appreciates at that break-even rate. And it turns out that sometimes we will sell a Bitcoin derivative because it's in the best interest of the company, but it's not necessary. This chart really illustrates that you can strip the business down to something very simple. You buy Bitcoin with credit, you let it appreciate, and then you sell Bitcoin to pay the dividend. And as long as you're issuing credit in excess of the break-even point, then this business works and grows forever. So how do we decide what to do? Because every single day we've got a bunch of trading decisions. Well, we have a very sophisticated equity and risk model. We calculate the benefits of the equity and the deltas to the risk for every single capital markets transaction. And that means we're making these decisions not just every day, oftentimes every minute of every day, based upon all the fluctuating prices of the trading pairs. Right now, our BTC rating corporately is about 3.3. The duration of our liabilities is 10.9. That's the stochastic duration. It's our estimate of of the stochastic duration of all the debt and the prefs. The risk that we've centered on works out to 818 basis points, and that works out to a fair credit spread of 61 basis points. 818 basis points of risk means that there's an 8% chance at the end of the duration of the liabilities that you're trading at a BTC rating of 1. And 61 basis points is the credit spread a rational investor needs to be paid to offset the risk. What you can see here is two things. First of all, the assumptions we plug into the model to estimate that centerline risk is 10% BTC ARR. We assume that Bitcoin will perform about at the level of the S&P 500 over the last 100 years. It's a fairly conservative, realistic view, and we plug in 40 vol. We assume that the asset will remain volatile ad infinitum. So we see that as two conservative estimates. But even with those estimates, what pops out is a credit spread of 61 basis points. The investment grade credit spread is like 88. And so this is investment grade credit, even with very realistic, pragmatic inputs. Let's delve a bit more into this. Here's the risk model. What you can see, of course, is that if you're a Bitcoin maxi, you think Bitcoin's gone up 30% a year, there is no risk. Right? The more bullish you are in Bitcoin, the more the risk drops away. If you're a tech investor and you think Bitcoin's as good as a Mag 7 stock and it goes up 20% a year, the risk is fairly de minimis. If you're a trader and you think Bitcoin is no different than the S&P, well, then you're on that 10% ARR line. And then if you think that the vol stays constant, you've got that 818 basis points. If you're a skeptic and you think Bitcoin's going up 0% forever, the risk increases. And if you're a hater, pessimist, and you just think that Bitcoin is going down ad infinitum, well, then the risk actually explodes. There's a lot of risk here, and you can see it in the model. We will show you risk numbers here with that realistic view, as though you're an agnostic trader. You don't love Bitcoin. You just think it's just as good as any other equity capital asset that's diversified. You can see you can calculate the risk with various Bitcoin prices, and you'll get the answer you would expect. Bitcoin price going up is good. Bitcoin vol going down is good. And on the next slide, you can see you can slice this with various assumptions about the outlook of Bitcoin as well. So let's look at some trades. If we decide to sell $1 billion of MSTR stock and buy $1 billion of Bitcoin, if you do that at less than 1.2 MNAV, when you do it at 1 MNAV, you can see it's dilutive. It's a minus 48 basis point yield. It costs the shareholders $310 million. For that reason, not very good idea. What you can see here is that as the MNAV goes to 2 or 2.25, it becomes a screamingly accretive deal. At 2, you make $457 million in gains on the trade. We've broken it down to basis points of yield. It's also another point, 57 basis points of BTC yields a lot of money. It's worth $1/3 billion. So it's not that complicated to see whether something's accretive or dilutive when you're swapping common for Bitcoin. You can also see here what it does to the credit risk. It improves our BTC rating. It decreases the risk. So whenever we're swapping MSTR for Bitcoin, it's credit positive. It's probably equity positive unless we're trading below that 1.22 break even. Now let's consider whether we want to use equity to pay the dividends or whether or not we want to use Bitcoin to pay the dividends. If we fund $1 billion of dividends with Bitcoin, it cost us $1 billion. It's $1 billion of cost to the shareholders. Look at the lowest line, you'll see it. It's a 12,763 Bitcoin loss, 156 basis points. And what you can see here is that's pretty comparable to funding the dividends with common equity at 1.22 MNAV. They're pretty much the same. If you fund the dividends with equity below that break even, it gets more expensive for the shareholders. It costs you an extra $290 million to fund at 1 MNAV. So you'd be better off to sell the Bitcoin than to sell the equity on this analysis if the equity's trading weak. On the other hand, if the equity is trading at 2 MNAV, then it only cost, $535 million. So it's an 83 basis point hit instead of a 156 basis point hit. So as you can see, we're always considering, do you use MSTR or do you use BTC to fund obligations of the company? What you'll notice is if you do use equity, it doesn't change the credit metrics at all because you're expanding the capital base of the company. With Bitcoin, it may be less dilutive, but it does slightly increase the credit risk. It drives down the BTC rating. The risk goes up 13 basis points. That would equate to like a 1 basis point increase in a credit spread. Now, what about funding the US dollar reserve to the tune of $1 billion? What you can see is, it's a lot more efficient for the shareholders to fund it at a high MNAV, like 2.25 or 2, than it is to fund it at a lower MNAV. And of course, it's constant to fund it at BTC. And that's the negative from the equity point of view. The positive from the credit point of view is it extends our duration dramatically. 160 days of duration. It decreases MSTR risk by 55 basis points. It improves the rating. Next. Now, what if we actually buy back one of the converts or some of the converts? You can see here, if we go and we sell $500 million of stretch to buy $500 million of convertible bond, we actually generate substantial BTC gains. We get a yield of anywhere from 22 basis points on the 2029 convert to 63 basis points of yield on the 2030 convert in the middle. So why? Because different converts have different equity content in them. And so some converts are more dilutive to the common than others. And you can see here all the analytics. You can see the impact on the rating. You can see the impact on the risk. Generally, we'll stretch the duration, we'll dramatically decrease the leverage, we'll slightly increase the risk, and we'll, of course, generate massive BTC gains through this trade. You have to evaluate this, of course, every day because the price of all the converts will be changing every day. And so this is an illustrative of the model we use. So what if we actually sold Bitcoin to buy the common stock back? This is not something that we have considered before, but I like to illustrate it because what you can see here is that below 1.22 MNAV, it's actually extremely accretive to the investors to swap BTC for MSTR. And so if you have an irrational market, let's say some crazy short seller shorted our stock to 0.5 MNAV, well, the most profitable trade, in the entire model is to actually swap BTC for common stock at a massive discount to MNAV, and you pick up 636 basis points of yield, massive amounts of BTC gain. And of course, the opposite is intuitive. If you're trading at a high MNAV and you're swapping BTC for the stock, you're generating a dilution. So, you won't see us swap BTC at a high MNAV, but you might see us swap it at a low MNAV in the future. And you can see all of these trades, they have a small impact on risk, but it's fairly de minimis. It's primarily an equity dilution or accretion. And, you can see we can swap BTC for MSTR, but here another very powerful tool the company has is we can swap STRC. We can sell credit to buy MSTR. So over time, as the business model becomes more well understood, the company has the ability to do its own levered buyout or LBO on its own common stock. We can create amplification. I'm not going to use the word leverage because leverage implies that you've got a debt obligation that comes due. Really, it's amplification on the equity. And if we wanted to amplify the returns of the equity, we would simply sell the credit and buy back the common equity. And of course, we get to take advantage of market mispricing. If the market perfectly prices everything, we don't have great arbitrage opportunities. But you can see here, even if the equity was trading at 2 MNAV, we can generate 85 basis points of yield by swapping $1 billion of credit for $1 billion of equity. But if the market trades down to 0.5 MNAV, we can generate 800 basis points of yield. So it starts to become pretty accretive, and this is an option in the future that we have as an operator. And of course, we can actually sell dollars to buy common equity. So you can see the impact of this. And of course, probably one of the more expensive programs we have is to carry the US dollar reserve. It's dilutive to the equity. It's equity negative, but it's credit positive. And you can see we do have the option, if the equity were to trade to a discount, to actually swap the dollars back for the common, and it would be extremely profitable for the common stock shareholders to do that. So we've got some scenarios here. We can continue with our conventional strategy at 1 times MNAV. So even if the stock was trading at a discount to break even, if we're selling credit and selling equity, and we use the equity to fund the dividends, and we hold the US dollar reserve constant at 1.5 years, we would run a 10.6% BTC yield, and we would accrete up to 263,000 BTC per share, or Satoshis per share over the next 3 years. So you can see, even if the market conditions aren't great, right? We have a business to deliver 10.6% yield. The duration would stretch out a bit. The risk would increase a bit. The fair credit spread, looks like 94 basis points, but it's still just a shade off of investment grade. So that's a conservative case. Should the market continue, if we were at 1.22 MNAV, you can see that the yield expands to 12.2%. The credit metrics don't change, but this is really positive for the equity investors. And now here at 1.5 MNAV, you can see that the BTC yield goes to 13.4. So you can see market sentiment and confidence in our ability to maintain this business, or belief in digital capital, belief in digital credit, is going to drive an expansion of the MNAV, which is going to actually drive an increase in the rate of accretion of Bitcoin per share. It's going to drive the BTC yield up. It's going to drive Bitcoin per share aggressively. And then at 2 MNAV, you see the BTC yield of this strategy gets you to 14.6%. So those are just different scenarios showing how market sentiment drives the business. But negative sentiment, it's a pretty good business. We'll double Bitcoin per share over 7 years, and positive sentiment means that we will double Bitcoin per share faster. Now, the company, as I said before, it can fund its dividends without selling any equity. We can fund the dividends by selling Bitcoin, and we can still grow Bitcoin holdings continuously. So here's a scenario where what we do is we fund the dividends, we fund the USD reserve at 1.5 years. We do it by selling Bitcoin, and you can see we drive a 12.2% BTC yield. We go from the 670,000 BTC level to 850 to 950 to 1 million. So we'll go through 1 million Bitcoin held on the balance sheet in the next 36 months, and we'll do that while funding all of our obligations with Bitcoin. You can see the impact. The impact that's measurable is a slight increase in credit risk and a slight increase in credit spread, but I think it would be a second order effect of the market. So this is interesting to keep in mind. Now, what happens if we fix the US dollar dividend and fund dividends with Bitcoin? Here, what we do is we just hold the dividend at 2.25 billion, and we pay all of our obligations by selling Bitcoin. And what you see is we get to a 14.7% BTC yield. Again, a slight increase in credit spreads, a slight increase in risk. But, this is without accessing the equity capital markets at all to drive the business. And, we're looking at first order effects. We're not really showing the second order effect and the third order effect. There are tax credit advantages that are second order effect. There's reflexivity in the common stock itself. It might very well be that, if people decided we weren't going to sell any common stock, they might actually decide that the rational MNAV should go to 2 or 3 or 4, And so we can't really model those. What we can just illustrate here is that even the first order model, it's pretty clear that the company has the option to run on the Bitcoin engine or on the Bitcoin derivative engine. MSTR is a Bitcoin derivative, and either of them are options. Here's a scenario where we just retire all the converts. And if we diverted 20% of the stretch issuance to retire debt, we retire all the debt in the next 3 years. We'll go from $8.2 billion of debt to zero. Net leverage goes to zero. The duration of our instruments goes up to 15 years. There's 114 basis points of credit spread, on the digital credit, but there is zero leverage. And we run with a 12.4% yield, and we maintain this constant 1.5 year USD reserve. And so you can see that's kind of interesting as well, and an option that's available to us. So here's a table that just shows all the various options. And of course, there's a lot of other things. We've got a sophisticated model. We can plug in any possible trade and any size on any day of the week. And rest assured, we're considering these every single day, and we're programming trading algorithms to trade all these instruments, sometimes every single second. And so the point that Fong made is the optionality in the business is expanding dramatically. You can see on the equity side, our assumptions are 30% BTC ARR, 20% stretch issuance, 11% dividend rate. On the credit side, we're much more pessimistic or conservative, or you could call it realistic if you want, 10% BTC ARR, high vol. If Bitcoin vol starts to fall as Bitcoin price appreciation accelerates, we have a lot of other options we can take advantage of, and rest assured we'll jump on top of those. I thought I'd show one last slide of interest here, which is sometimes people have this misnomer. They think that we're borrowing money at 11.5% and it's a fixed obligation. That's not correct. We're not borrowing money. When we sell $1 billion of stretch, we're never paying it back. And so the first obligation is stretch is a perpetual swap. It is not a loan. And the second observation is the cost of capital is not 11.5%. There is a stochastic cost of capital. What stretch is a perpetual swap where the issuer agrees to pay SOFR plus a credit spread, a variable credit spread adjustable each month. And then the issuer invests that in Bitcoin. So we are paying SOFR plus a credit spread. We are taking back the Bitcoin return, and the company, the issuer, has a couple of very powerful options. One powerful option the company has is over time to reduce the credit spread. That is an option. And of course, the credit spread is probably at a high point when you're early in the industry, when digital credit is not understood. But you would think after 3 years or after 6 years or after 9 years, the credit spreads will compress as confidence in Bitcoin grows, as confidence in stretch grows, as AUM grows, as confidence in the business model grows. The credit spread should compress. The second option is the company has the option to lower the dividend to a floor of SOFR. So as SOFR falls, when SOFR's 375 basis points, that's the floor. But if SOFR goes to 200 basis points, the company gained 175 basis points of additional optionality. SOFR has gone to 0 or 25 basis points in the past. So the fact that SOFR generally fluctuates between 500 basis points and 25 or 50 basis points on an 8-year cycle is a very important point. And when you consider those two options, the stochastic cost of capital for stretch, has to be modeled as something less than 11.5%, maybe more than the long-term rate. If you imagine SOFR is 2 or 3% and we have a 300 basis point credit spread 20 years out, that might be 6%. So somewhere between 6% and 11.5% gets you to like a blended rate of 875 basis points. So when we think about the cost of capital, we think that it's probably 875 basis points and the debt's never coming due. And I think that's an important point to make to the world. And it colors your thinking. And so with that, I'll just end with our capital markets principles. And I'll reiterate what Fong said. You know, we're here to drive Bitcoin per share up, and we're doing everything we can to drive Bitcoin per share up. We think the best product and the best tool to do it is Stretch. And it's clear the market's telling us that. And so we will focus laser-like on making Stretch the best digital credit instrument. We do see a world where we're debt-free, and sooner rather than later. We're going to adjust our amplification and our credit metrics and our US dollar reserves and our use of proceeds based upon market feedback. We get market feedback every minute. We're literally staring at all these signals every minute. And of course, we're talking to every credit investor and every equity investor continuously. And again, with Bitcoin, the company's got more than $60 billion of Bitcoin, and the Bitcoin market has $20 billion or more of daily liquidity. If we were to be boxed in by a troll or a cynic or a skeptic into agreeing that we're never going to sell the Bitcoin and we're never going to tap the liquidity, we would be impairing the asset which accounts for 99% of the future of the company. So, you know, it's kind of like a real estate developer saying, I'm just never going to sell any real estate ever at any price. It's kind of a silly thing. If a wealthy person, you know, if a billionaire sells $1 million or spends $1 million to make $1 billion, nobody says they're poorer. And nobody would lament that spending a few $1 million is going to crash the U.S. currency either. I don't think that if we spend $100 million of Bitcoin or sell $100 million of Bitcoin to pay a dividend, I don't think it's going to negatively impact the Bitcoin network. I think it's probably good for the Bitcoin network. It definitely doesn't impair our business model. If anything, it just creates more optionality and second and third order effects. So the management team's practice is to run the company in the best interest of all the stakeholders. And that means there are three that we laser-like focus on. Whenever we're making a decision, we ask the question, is it good for the common equity, MSTR? And we ask the second question, is it good for the creditors, especially STRC investors? And the third question we ask is it good for the capital investors, BTC investors? And we happen to believe that running our business in such a way as to commercialize digital credit in the most efficient fashion is the best thing we can do for Bitcoin and Bitcoin investors, the best thing we can do for digital credit investors, and the best thing that we can do for our common equity investors. There is no conflict between those three goals, because if we sub-optimize to the benefit of one to the detriment of the other two, the entire machine doesn't work. And so when we balance the interest of the three, the more credit we sell, the higher the equity MNAV, the higher the equity MNAV, the more credit we can sell, the less the credit risk, the more Bitcoin we can buy, the better it is for Bitcoin. The better it is for the price of Bitcoin, the less risky the credit is, the more profitable the equity is. There really are concentric flywheels here, feedback loop within feedback loop within feedback loop. And when we're in harmony, all of those feedback loops are working really well. And you can see that happening in the market. We monitor it. And indicia of everything working is when the MNAV is expanding and the equity is healthy and the equity is outperforming Bitcoin, when the volatility of Stretch is falling and liquidity is increasing, right? That is indicia of the success of the credit. And when Bitcoin price is appreciating, yeah, and Bitcoin support and liquidity in the world is appreciating, that's indicia of success of the capital. And so that's what we've been doing. That's what we'll continue to do. And we thank you for your support.